Welcome to the TAC Index AI podcast, April 1st, 2026, where we blend TAC IP data, reports, and charts with the latest news in all things logistics with a focus on air cargo. So picture the world's oceans standing virtually still while the skies above are running, well, dangerously low on fuel.
Yeah, it is a wild scenario to visualize.
Right. For this deep dive, we're mapping out how just one single geopolitical choke point is basically rewiring global freight right in front of you. We'll be unpacking a real-time surge in air rates, stalled ocean shipping, and some pretty serious macroeconomic shockwaves.
It really is a fascinating case study in cascading logistics failures. I mean, we're seeing disruptions that force us to look closely at how fragile these interconnected networks truly are, when a major node gets taken offline.
Yeah, exactly. I mean, looking at the latest TAC index numbers, the sudden shift is just jarring. The global Baltic air freight index, which gives us a clear look at transactional rates across key routes, well, it jumped 9.3% in just 1 week.
Wow, almost 10%.
Yeah, and it gets crazier. Outbound flights from Chicago are up over 28% week over week. And over in Asia, major hubs like Hong Kong and Shanghai, they are seeing steep single and double-digit spikes too.
Right, because we are watching the physical reality of the conflict in Iran effectively closing the Strait of Hormuz.
Right, the ocean routes are just blocked.
Exactly. When a maritime artery that critical gets severed, you suddenly have millions of tons of ocean container capacity they're trapped. But, consumer demand doesn't pause, so shippers are forced to bypass the water entirely and scramble for belly space in cargo planes.
It feels so much like rideshare surge pricing to me.
Yeah.
Like the subway, or our ocean freight network in this case, breaks down during rush hour. So everyone rushes up to the street to grab a car, but there aren't enough cars.
So the algorithm spikes the price.
Exactly. That capacity squeeze makes perfect sense. But here's my question. If every shipper is suddenly pivoting to the sky, how is the skyrocketing cost of jet fuel impacting all this?
Well, that is the friction point making this so incredibly painful. We are seeing numbers from Platts, the benchmark agency for physical energy markets, and they are showing jet fuel prices up over 100% year over year.
Wait, over 100%?
Yeah, it's massive. You have airlines burning twice the cash just to get off the tarmac right when demand is peaking. And it's draining reserves so fast that countries heavily reliant on imported refined products, like Vietnam, are actively warning about looming jet fuel shortage.
Oh, wow. Which means the cost to fly a shipment of semiconductors or car parts just doubled. And that's on top of the actual cargo rate surging.
Right, the costs are compounding.
That logistics nightmare has to be distorting the broader economic picture, right? Like we are seeing global factory input costs climb. But I noticed something weird with the manufacturing purchasing managers indexes, the PMIs.
Yeah, they look surprisingly strong for a global supply chain crisis, don't they?
Exactly. Why is that?
Well, they are essentially hallucinating. The PMI calculation inherently factors in delivery times. In a normal economy, if delivery times stretch out, it means factories are swamped with orders.
Which is a positive sign of growth.
Right. But right now, delivery times are stretching simply because ships are anchored or physically rerouting thousands of miles to avoid Hormuz.
So the index interprets a severe supply shock as a booming economy. The data is literally backward.
Precisely. And financial markets are experiencing a really similar disconnect. You probably saw Brent crude, the global benchmark for oil prices, dip below $100 a barrel recently.
Yeah, the Hormuz hope rally, right.
Right. That was entirely driven by statements from the U.S. president suggesting the conflict in Iran might be wrapped up in a few weeks. Traders just started pricing in that optimism.
But the physical data paints a totally different picture. The International Energy Agency warned that April's actual physical oil supply losses are going to be twice as bad as March's.
Yeah, the financial markets are trading on political optimism, while the physical supply chain is running dry. And, we are not endorsing any political stances here, just strictly conveying what the IEA and the market reports are showing. But the physical reality always wins out.
It has to, right?
Yeah. Even if a ceasefire is announced tomorrow morning, the sheer volume of vessels backlogged at the Strait of Hormuz will take weeks, if not months, to untangle. That maritime traffic jam prevents production and energy flows from simply snapping back to normal.
Which leaves you with a really interesting thread to pull. If these choke point disruptions become the new normal, we might see companies stop relying on emergency air cargo to save the day.
Yeah.
They might fundamentally rethink their geographic footprint, like nearshoring their factories so they don't have to cross these volatile straits in the first place.
It is definitely a long-term shift to watch.
Definitely something for you to consider as you watch those air freight rates climb. Until next time.